We had the rand end firmer against the dollar on Friday. It hit a two-week low of 6.96 before recovering to a session high of 6.84. And for the most part, expectations were that it wouldn't be able to sustain that kind of strength moving into this week. Certainly, what we've already seen come to the fore is that further weakness.
Good morning, Alishia. Yes, it did prove to be very temporary, the strength that we saw in the short covering on Friday afternoon. By the time we left work on Friday, it was quite clear that the market was not convinced at that stage that global growth was out of the woods, and there was still a lot of concern surrounding the global growth outlook. So we did see that temporary short covering, but the rand was already starting to show signs of renewed weakness just before the end of the day. And of course then we had the big downgrade over the weekend, and the rands opened accordingly a bit weaker this morning.
Having said that, we've seen the euro jump on hopes that the ECB will act to stop Europe's debt crisis from engulfing Italy and Spain. How are you reading that scenario and what it may translate to for the local unit?
Yeah, well, there's no doubt that dollar rand is remaining very closely linked to that euro dollar performance, and it was reassuring to see the ECB coming out and saying that they're going to buy both those countries' bonds going forward. But I think this debt situation is less of a concern to the much bigger concern, and that is the global growth outlook. It really doesn't look good at this stage. And I'm afraid if the employment figures were just a case in point there. The average employment rate in the States over the past few decades has been around 5%. We're still about over 9% in the US, and I think that's at the epicenter of a lot of concerns. Of course, the markets have been spooked by what's happened over the weekend, but we will probably see these policymakers like the ECB and the Fed coming to the party to address and the debt issue as much as possible. But what they really need to get right is to try and reinvigorate this global growth, because if global growth remains poor, then emerging markets are going to probably suffer.
With that, we've had attention really turning to the Fed's next policy meeting, which is, of course, tomorrow, which may signal renewed efforts, some say, to support, the economy. What are you anticipating on that front? Because while, the intention to put in more effort may be there, we've got the Fed really at this stage running low on ammunition.
It is running low on ammunition, but of course I think if we do see the Fed signaling the possibility of another round of quantitative easing, then you'll probably see commodity prices and risky assets actually rallying again because of the increased liquidity injection. And that's the risk, of course, because if we look back at how successful this quantitative easing has been, it actually has just inflated certain asset prices, and if we look at the Dow Jones as an example, we're back to where we were before the whole quantitative easing really kicked off. So I don't know how effective it is if all you're doing is creating high commodity prices and overvalued emerging market currencies. I think what they would like to see is to try and get that money channeled into businesses and corporates and ultimately get global demand back on track. And that's going to be the key issue. And probably if we do see some kind of more stimulus measures, it's probably going to be in that vein, rather than just buying US Treasury bonds and just injecting liquidity into the broader market, which ultimately doesn't get down to the man in the street and ultimately doesn't or hasn't as yet created sustainable demand.
Well, what will be providing some sense of the kind of demand that is out there is some of the local data that we're seeing filtered through this week. Later on Thursday, we've got gold and mining production report being released. Your broad expectations on that front, Michael?
I think both sectors are going to be, more so the manufacturing sector, remain somewhat under pressure. Global demand, obviously, as we've been saying, is pretty weak. The rand has been pretty strong. So we would expect, based on what we've been seeing in some of the PMI readings, for the manufacturing figures to actually soften on the previous reading. And then, of course, we've also got the domestic strike activity, which continues to intensify. Now, all of that doesn't bode well for South Africa's growth prospects in an environment where everyone's looking at economies that are probably going to outperform in terms of growth. South Africa's internal growth combustion is not looking at very strong at all, specifically with the strikes. And now added to that, you've got the manufacturing sector, which is a huge employer and ultimately a huge creator of consumption demand, is reeling. So not looking good on a GDP differential front, and as a result, probably another reason to sell rands at this stage.